Namaste and welcome to Quant Risk channel. Let me begin with a real incident. I was once discussing options with a friend and explained the very basics. When a stock price rises, call options go up. When it falls, put options gain value. I even showed him CE and pay symbols. And he was delighted to see them move nearly 10%. But just a few days later, the moment derivatives came into the conversation again, his reaction was, "Ye sab fraud hai." He was frustrated because the stock was falling. Yet the put option was also declining. This experience is not unique. Most retail derivative traders fall into the same bracket. Without deep understanding, they indulge in these complex products and end up disillusioned. Of late, the derivatives space has also become a hotbed of regulatory activism. From the Jane Street saga to changes in the weekly expiry cycle, the signals are unmistakable. Step by step, regulatory vigilance is intensifying. Lot sizes have been raised. Weekly index expiries per exchange have been capped at 1. And large institutional players such as Jane Street have come under scrutiny. Taken together, these developments underscore a single message. Regulators are tightening their grip. Against this backdrop, let us examine the fate of retail traders in the derivatives market. Who really benefits from retail derivatives trading? According to SEBI's 2024 report, retail traders lost over 1.8 trillion rupees in just 3 years. A staggering 91% of individual traders ended up in losses. This raises a critical question. What exactly is at stake here? Let's identify the winners in this landscape. The government, exchanges and trading platforms, data providers, and institutional market makers are the ones who consistently benefit from retail derivatives trading. Meanwhile, the majority of small investors remain on the losing side. The government benefits primarily through Securities Transaction Tax, or STT, on every trade. Their revenue is tied to transaction volume, not profit or loss. That means, even when retail traders lose money, the exchequer earns tax. More trading activity simply translates into higher revenue streams for the government. Exchanges and trading platforms thrive on brokerage fees, transaction charges, and margins. The more retail participation, the higher their revenues. It doesn't matter whether you win or lose a trade, every order adds to their bottom line. And when volatility spikes, transactions multiply, and so do their earnings. Data providers also profit significantly. They sell real-time feeds, analytics, APIs, and premium subscriptions. Since retail traders rely heavily on data to make decisions, higher trading volumes naturally lead to greater demand for these market intelligence services. Institutional market makers benefit through liquidity provision and spread capture. They deploy advanced algorithms and risk management systems, while retail traders often act on emotion. In effect, retail losses translate directly into institutional gains. But this system creates problems. High retail losses increase systemic risks. Growing F&O activity fuels volatility. Clearly, there is a need for structured advisory frameworks and better risk management guidance for small traders. So, what's changing? First, the increase in Securities Transaction Tax. The government raised STT in 2024 on futures and options with the intention of discouraging excessive speculation. While this move generates additional revenue, it also makes trading more expensive for participants. At the same time, the expiry cycle has been adjusted. NSE and BSE now have different expiry days for their benchmark indices. This shift was designed to improve flexibility and liquidity in the market. But there is a flip side, it has also encouraged a high frequency of speculative trades. More changes are here. Derivative lot sizes have been revised upward, making contracts costlier. The objective is clear: limit small traders' exposure to leveraged products. Regulators have also restricted weekly expiries on exchanges to just one index, aiming to reduce speculative churn and bring discipline to derivative trading. Remember, derivatives are here to stay. They are an integral part of the financial system and play a vital role in market stability. But while traders have access to abundant information on open interest, volatility, and Greeks, many still lose money. Why? Because trading is not just about data, it is also a psychological game. The ability to connect the dots and craft a winning strategy matters most. Let's acknowledge the reality: 91% of retail traders lose money. We have nearly 10 million regular traders, many of whom use complex leveraged products without proper advice. This is why SEBI is focusing on investor protection, suitability norms, and financial education. The goal is simple: reduce systemic risks and build confidence in the market. To conclude, let's build a safer and more informed trading ecosystem together. And for more insights from the Quant Risk channel, don't forget to subscribe, like, and follow. Better listen than repent.